Let's bring in Chicago Fed President Austan Goolsbee. Austan, thanks for joining us this morning.
Good to see you again, Steve.
So, Austan, there's a perception out there that the economy is either in or close to a recession, and the Federal Reserve is about to embark perhaps on an emergency cut or a series of rate cuts that will slash the federal funds rate. I'm wondering if you could comment on where the market is priced and also what your perception is or your outlook is for the economy and the funds rate.
Well, look, Steve, you know that I'm not allowed by rules to talk about what happens at the meetings or anybody's opinion but my own. I've been saying to you for a long time that we've been in a restrictive posture at the Fed. If you look at the Fed funds rate minus inflation, the real Fed funds rate is as high as it's been in a long time, and we're at the peak even in this cycle as inflation comes down. And you only want to be that restrictive if you think there's fear of overheating, and that these data, to me, do not look like overheating. So I think the Fed is forward-looking. The Federal Reserve Act gives us a straightforward job to stabilize prices and maximize employment, and that's what we're going to do. And so as you see jobs numbers come in weaker than expected, but not looking yet like recession, I do think you want to be forward-looking of where the economy is headed for making the decisions, and remember that, say, the payroll jobs number is plus or minus 100,000 a month, so be a little careful over concluding about things in the margin of error.
Would you step back, Austan, and maybe sort of put it in context? Jobs number was probably the worst number we've had, but we've also had a bad ISM manufacturing index. Are there other indicators out there that suggest to you that we've missed the idea that this economy is in recession or about to go into one?
Yeah, the manufacturing's a little complicated for the reason that we went through a pandemic with a downturn where spending on physical goods went up, very unusually compared to previous business cycles. So you knew that as people shift back what they're spending towards services and away from manufacturing, that there would be some weakness in manufacturing, even separate from the business cycle. So we gotta calibrate that one, and it's not as easy. Now, that said, there are other cautionary indicators that I've been citing for a long time, like the rise in consumer delinquencies, the rise in small business defaults. Those things have been trending the other way, and now they're to levels that they have not settled at levels that you think of as being during boom times. On the other side, if you look at domestic purchases, the GDP number was relatively stronger than we expected.
Right.
The previous one was a little weaker than expected, but in total, the economic growth continues still at a fairly steady level.
Also, I want to ask this outright. The market is priced for 150 basis points or more of cuts by through January, for a 50 in September. Is the market over its skis here? Do you think it's sort of embraced a panic about the economy that you don't have?
Well, look, you know I never like binding ourselves ahead of time before meetings, even a single meeting, much less 5, 6 meetings from now, because we're going to get a lot of information. It seems like there's a lot going on in the world as well. You got the Bank of Japan raising rates when everybody else is cutting rates or thinking of cutting rates. And so you got movements in the exchange rate. And so the international component of this is probably a little more complicated. I think the market's reaction, if you just plot out what their projected Fed funds rate will be and plot it against what the actual Fed funds rate does, you can see that it's the market's job to react and it's the Fed's job to act. And one of those moves with a lot more volatility than the other.
I understand, I think, what you're saying there. Is there a chance, Austan, you think, of an emergency cut between now and September?
Look, like I say, I'm forbidden to talk about what people's opinions are or speak for the committee. You've seen the table. It's a huge table. So everything is always on the table, whether that's increases, cuts, et cetera. But the Fed's job is very straightforward. Maximize employment, stabilize prices, and maintain financial stability. That's what we're going to do. We're forward-looking about it. And so if the conditions collectively start coming in that on the through line, there's deterioration on any of those parts, we're going to fix it. That's the Chicago model. There's no bad weather. There's only bad clothing. The conditions come in. We're going to respond.
Austin,
as
I think the question is the balance between the two of these of this dual mandate. For a long time, you didn't really have to think about the jobs piece at all. And at what point? What is the inflection point at which you say to yourself, "Okay, now we got to actually forget about the inflation piece. Let's focus almost solely on this other piece"? Or do you think it's not that way?
Well, barring a major change, it's not that way that you would ignore the price stability piece. But I'm mentally have been saying for some time we're in a balanced risk posture, which is to say we could go for a long time just focused on inflation because inflation was the place where we were falling down and the job market remained extremely strong. Now you see some weakness in the job market. We have to pay attention to that. And as I say, my view is we're as restrictive in real terms as we've been, higher than this entire cycle and highest in many decades. And you only want to be that restrictive for as long as you have to. If you don't think there's a chance of overheating or it doesn't look like overheating, it's not the right time to be tightening.